I have a dream. The idea is just like you have SEBI registered investment advisors. You make SEBI registered mutual fund advisors.
Yeah.
That you make all SEBI mutual fund distributors, mutual fund advisors registered with SEBI, and you get a fee from the investment, not the investment value. That is, if I invest 1,000 rupees, you get a fee of 1% from that 1,000 rupees, not from the market value. You deduct
and
that
not
1%,
from the profit.
Exactly. You deduct that 1% and invest the remaining in the mutual fund. Remove the distinction between regular plan and direct plan. And remove all ties between the AMCs and the intermediaries.
Absolutely. Wow.
Then the conflict will go away, but nobody will do it.
Hello and welcome to Let's Get Rich with Pattu. Yet another week where... Let me take that back a little bit. On this particular week, we're not sure what we're going to be talking about. And Pattu and I have decided, why not have one of those episodes? You know, the data on YouTube is showing that our episode, Pattu, which we did, which was a Q&A, the first Q&A we did with listeners' questions, did really genuinely well. And it's a no-brainer, of course. You know, we're answering your particular questions and you have an incentive to listen, etc., etc. But we like those kind of episodes also once in a while because they just... Both Pattu and I don't know which direction this conversation goes in, right? There's not any preparation you can do for such an episode. So this is one such episode where we have some fun, a wide variety of topics and questions. And Pattu's been very nice to, you know, go on this journey with us. Pattu, my first question for you, of course, how are you doing? And how much do you invest on a monthly basis on your fitness, on your physical fitness, and on your personal relationships? And I'll give you a bit of background of why I'm asking this question. This thought has been stuck in my mind for weeks ever since you brought it up, and it makes so much sense. What is the point of planning for retirement if it's not a healthy one and it's not a happy one? And so how do you quantify? Because it's as important to invest in these two things as it is to invest in mutual funds and fixed deposits, etc., etc. So do you quantify such an investment?
Yeah, so I'm doing well, thank you. It's hard to quantify these things. Yes, I don't keep track of how much I invest. Invest as in not time, but money. That's what you have.
Yes,
in mind,
yes.
right?
Time, though, you have to invest time, right, in both these things. But it'll be very interesting if you try to quantify it, Pattu, because, you know, if you're forced to invest, say, a particular percentage of your monthly salary or your earnings, then at least it makes you start to think about this very important part of life.
So there's this doctor on social media, I forget his name now. He's majorly into fitness. In fact, you would think that is a no-brainer, but it is not. Most doctors are not fit.
Absolutely.
Yeah.
Oh, I have so much to talk about on that front, but please keep going.
They help save our lives, but they themselves are not fit. But this guy is very health conscious, and he says it is very expensive to eat healthy in India, or maybe anywhere in the world.
Absolutely, 100%.
So, man, as I've talked about, and you also like the idea of a low carb diet. And so, if you want to eat a low carb diet, one, you have to, and assuming you're a vegetarian, one, you have to spend a lot of money on veggies, much more than a normal household. And vegetables can be expensive. I mean, it's seasonal and so on. That's one thing. And also, I eat a lot of nuts because protein sources
very expensive.
And all kinds of nuts are expensive. The peanut is, of course, not a nut technically, but it's the least expensive of all. So it is expensive. And the question I would put, I will ask myself this, your question, in a slightly different way. Would I be doing this 10 years ago when I had very little net worth? The answer is no.
That's a very interesting way to put it. I guess when you have very little, then fitness goes to the bottom of the ladder. Absolutely.
You just make do with what you can.
And there are very many ways you can make do with what you have, right? So there was this incident during the pandemic, Pattu, where the pandemic began. We were stuck at home, and a month passed, 2 months passed, 3 months passed. And how much sit-ups and push-ups will I do in my bedroom? I grew... And if I don't work out on a particular day, it really starts to bother me, right? And I've noticed if I work out every single day, my mental health is in a good space. And I went and made a decision of buying this weight set, my family thought I was bonkers. It was a large amount of money, but it changed everything. The next 2 years, I didn't know the pandemic was going to be 2 years, right? I just took a risk. I took a bet and I bought that Olympic weightlifting set. Then I had to buy mats because you can't bang that stuff. The entire building complained. And that held me in good stead for 2 years. I came out of the pandemic much fitter than I had going into the pandemic. And of course, now the rest of the building uses it, etc., etc. I feel it's one of the best decisions. But of course, this is a quirky one-off story. The point is, on a regular basis, on a monthly basis, I find supplements expensive. I find whether they're protein or multivitamins, etc., etc. But you're right. We do this because we can, and if we can, I think there's no real scientific or mathematical way to quantify it yet, right? There are some people who go berserk, right? So here in our team also wants to discuss about frugality. And one of her parts in frugality was I read an article and she sent some feedback about how people spend a lot of money on gym memberships and then use it twice. And so in those cases, that's a really silly investment. But anyway, these are left field topics that I wanted to bring up, Pattu. Is there any kind of way you can quantify investing in relationships?
I think you should not. That's probably the best way to it's hard. I mean, I don't know. I think you have to see the way I'll put it this way. Let's say you hate gold. There are
Yes.
many men and women who hate gold. As an investment for consumption, whatever, in whatever form they hate it, but the other partner will disagree. So what do you do then? You compromise. I mean, maybe you don't agree to 100% of their expenses, but at least to 50-60% of their expenses, because peace in the home is more important.
Sure.
And you can't put a price on that. And there's one point I missed talking about. We had talked about retirement a lot.
Yes.
And I regretted not forgetting this on that episode. Now is a good time to say it. Now, we keep talking about how much money to invest, what is the corpus, inflation, sequence of returns, rebalancing, etc., etc., etc. But the most important investment for retirement is relationships. And of course, this is for people with a family. People who are alone, well, they're in trouble as they grow old. I mean, as long as you have your faculties and physique okay, you're fine. That's true for everybody. But at some point, they're going to fail you in some ways, occasionally, regularly, permanently, whatever, in some form. At that time, you definitely need the help of your spouse. You need the help of your children, their spouses, etc., etc. So so everything that we do today, what we sow today, we will reap later. If we kind of are very oppressive on our children, don't do this, don't do that, and that kind of thing, the first thing they're going to do when they get the chance is run away from us. Of course, it's natural that children leave the house, it's fine, but they may not want to come back at the time of our need. Yeah. So all our money, we can be a multi-crorepati, but if we don't have the faculties to use the money to dispense with it with the way we want, and there's nobody to help us, we are in big trouble. So relationships are non-negotiable, and I think we should, of course, we can always talk around and we can always discuss things and say, look, I think what you're doing is wrong, but I'm not saying no, but let's kind of find a middle ground and so on. Yeah, but I think we can't put a percentage to it.
So a very viral, I don't know if it's very viral, but I remember seeing it and it making an impact on me. There's this person who interviews this billionaire in the US, and he asks him, after all these years of being wealthy, what are your life lessons you want to share with the world? And the one thing he says is, what is real success? What is the point of doing all this if at Christmas time my kids don't want to come home and meet me, right? And for me, that was very telling. He said, it's all pointless if you do not have those relationships. That is true success. And one quick anecdote from my personal life also, right? So each time there's a chance of holiday, as there will be soon, right? December and New Year's. There's like a sparkle in my wife's eyes, because her way of spending every holiday is going to a new place. And of course, we all enjoy it. Absolutely. I mean, hands down, who would not, right? Enjoy traveling and going to a new place. That's her biggest kick in life. But this time we had a bit of a fight. And I'll tell you why. Because of one of the episodes we recorded, and you're talking about relationships being so important, I insisted this time we go to a place we've been to often because of very close people we are close to, and we haven't met them in over a year and a half or 2 years. Right. And for us, it was a bit of a back and forth, lots of debate. And, why? What's the problem? And I told her, when we are old and gone, what are you going to say? Oh, we lost touch. You have to work towards these relationships. You have to go and spend time. So that's my little bit of anecdote. And before I let you go, Pattu, the thing you said about if one person likes gold and the other, from a pure let's get rich with Pattu mentality, have you ever done any backtests on gold ETFs? Because there are lots of questions we get in comments. Why doesn't Pattu talk about gold? Is it a commodity that has proven over a long period of time, of course, not short term?
So there are several aspects of gold, and I think I mentioned some of this in the episode we did with forget her name, the DSP.
Yes,
head.
Aditi Kothari.
Yeah. So the first thing I don't like about gold is it is a asset that thrives on fear. Whenever things are gloomy and everybody is pessimistic,
that's when it goes up.
That's when it goes up. Whereas equity thrives on hope. When everybody is gung-ho about, yes, the economy is going to boom and the short term, long term, whatever, then it kind of moves
But
up.
that makes it a good hedge, right, Pattu?
Is it? The point is, I have shown earlier that I don't have the data now to show you, but I have shown earlier that it's really not a great hedge because the point is that the gold prices are extremely volatile. It's controlled by supply and demand, and it is controlled by the currency. Gold USD and gold INR have been very different. What you see in the past, so if you look at gold USD, if I'm not wrong, from the 80s to the 2000s, right until the 2008 crash, the gold USD was falling down. Whereas gold INR is moving up. There was a complete, divergence.
How is that possible?
That is because the gold, the commodity was going down, but Indian economy was opening up, and the INR became, globally priced.
Right.
And so what was internally priced now became globally priced. Suddenly the US dollar went. I remember my dad saying the US dollar jumped from 12 rupees, 15 rupees to something like 35, 36 rupees in the early 90s. Right. And then it started moving up because we were bankrupt. Right. Throughout the 90s, we were bankrupt. And only after the stock market picked up in the early 2000s, etc., and so on, it slowed down. So, and there's a huge divergence. And the returns that we see, the 25-year, 30-year, 40-year returns of gold, everything is kind of based on that. And since the last decade, from the 2010s onwards, gold USD and gold INR have more or less been in step. That divergence has more or less died down, almost died down, and that's because the rupee has gotten stronger. People look at past data and say, oh, the rupee is always going to depreciate. No, the rate of depreciation is significantly decreased.
Yeah.
So our economy has gotten very strong, and I'm very unhappy about personally, I don't want to invest in anything that thrives on fear and despair. And I don't think it is going to make a big difference to my portfolio because people will say, oh, have 10% of it, have 15% of it. Most people don't know what that implies because today you will have 10%. When it's small caps, 10% is okay. Gold, 10% is okay. Rights, 10% is okay. How many 10% will you have in that 100%?
Clutter and no way to quantify this diversification.
And it's not going to remain at 10%.
Yeah.
Tomorrow, if gold doubles or small cap market, zooms up, that 10 will become 20. What will you do then? Most investors don't have an answer. It's like a untended garden. They'll just let it grow, and you can't tell the plant from the grass. And if you do that, right? So and it's extremely volatile. People talk about sovereign gold bonds, etc. The answer to what is the return I will get from gold after 8 years, after 10 years is I don't know. The same as equity. I don't know. That's why I said before, financial literacy is saying I don't know. So it's too volatile. I don't want to take a risk. I will have my risk everything concentrated in equity and have safe fixed income. That's good enough for me.
I hope that answers your question. All you listeners who've been asking about gold, a lot have been asking about cryptocurrency also, Pattu, but perhaps at a later date. A number of questions, by the way, are asking you for your prediction for the next 5 or 10 years for India. Now that you mentioned about how the rate of depreciation of the Indian rupee is slowed down, do you see it now? You know, it's around 82, 83 to a dollar. You think that'll go to 70 at a
No, it won't go to 70. It won't go to 70. It will. It will not zoom up. Or at least it will not zoom up continuously. It can zoom up sporadically. Now the point is that the big mistake that investors do is, if I say that I'm extremely confident about India, the growth of the Indian economy over the next 10 years, 5 years, that does not mean your investments will grow. Those two are not linked. There's no one-to-one correspondence. Returns can fluctuate. The economy will gradually grow because, see, you can't quantify an economy. GDP is a very approximate estimate. You can't quantify a GDP properly, right? And if you say GDP is growing at 6%, there'll be 100 people who will say, no, it's wrong. Or maybe some people will say it's more. I mean, it's very subjective. So those two are not linked. And however, as a country, as a citizen, I am extremely proud of what India has accomplished over the past few decades. I've seen the change. I'm very lucky to be alive during a time when the economy has changed, the mindset has changed. When I was a kid, people used to complain about population. Oh, in India, every problem in 2 steps you can trace it to population. Population is the biggest problem. No, population is our biggest wealth. It is the reason why our economy is thriving. I'm extremely confident and optimistic about India, but that does not mean your investments will reflect that, should reflect that optimism. You should be conservative there. And the other problem is global warming and climate change are going to play a very, very important role in the next few years to come. And capitalism is gradually destroying the earth, whatever, square feet by square feet or whatever you want to call it. And that is going to determine how our future is going to be. Somehow, I'm happy to have escaped half my life, more than half my life. I think I've lived in a reasonably good planet. I'm very worried about the future of the world in which my son will live.
If you see any changes on Marina Beach, please let us know. But as soon as you do, climactically or whichever way. It's amazing. Like, we can just keep chatting about stuff. It's almost 16 to 17 minutes into the episode. We have not even begun the user questions, so let's dive straight in, Pattu. The first category is on the RIA episodes we have had, right? And very interesting perspective. I know you've responded to it in text on YouTube, Pattu, but I thought, interesting line of thinking, right? It's from Navodit Jain. Pattu, don't you think that having a fee-only advisor will also not work in the interest of the client, as it doesn't matter to him how your portfolio performs? He will keep earning his fee. Wouldn't a combination of flat fee plus a percentage of profit, say 10%, or, that can be discussed, will make much more sense, as the RIA's interest will now be more aligned with the clients? Also, most of the time, the flat fee itself is very high, but I mean, that's a separate discussion. That's not the part of the question I want to deal with. Just playing devil's advocate, Pattu, and I'm sure Vikram will also understand this line of questioning. Yes, we get that comfort on the first meeting or the first year. We have a model in place, a plan in place. But how do I get that comfort about the future?
So, a fee-only advisor is not a fund manager.
Yes.
A fund manager is expected to take care of a basket of securities in which we have invested 24/7, right? And therefore, she demands a percentage of AUM fee. Whether it is a passive fund or a active fund, it is always a percentage of AUM fee. Whether that is justified or not is a different matter. That's always going to be subjective. You can always argue a fund manager can also get a flat fee, but they also have to grow. I mean, the AUM has to increase and so on. But a fee-only advisor is not a fund manager. The fee-only advisor recommends products to clients. These products are themselves governed by other fund managers, right? And so once a year is more than enough for a financial review. So I make an initial plan. I pay a fee of, let's say, $25,000. I have a lot of clutter in my life. The $25,000 is basically used to declutter everything, strategize, organize everything, put it on a path. And so you say, that's the path you're going to go. That's fine. And you're going to go. The portfolio is going to grow. The portfolio governed by other people, not by the advisor.
Yes.
After 1 year, you come to me and say, am I doing okay? So I do a review. I have already done the decluttering. So most of the job is done. Why should I get paid for that? So I only get paid for half of that initial fee for finding out if everything is okay, things have changed, if any new development is there in your life, etc., new kid, whatever, and so on. And so I do that every year, and that's the arrangement. Now, it makes no sense for me to, if a fee only advisor says, I also want a percentage of fee on your assets. Already some fund manager is getting a percentage of fee. I am only recommending those fund managers to you. And for that recommendation, I need a percentage of fee. It's a double fee, and it makes no sense to me. And it is a strong misconception that just because I am getting a percentage of your assets as a fee, I care more about you. Oh no, that's not true at all. And look at the data. Most of these products, which typically these percentage AUM guys recommend, whether it is a PMS or whether it is an alternative investment fund or whether it is a REIT or active mutual fund, whatever, any stock basket, curated stock basket. What is the data that we have? The actual data that we have is either the product is new that we don't know, and most of the products in India are like that, or the data that we have is 50% of products in a particular category fail to beat the benchmark. I'm going to recommend these kind of products to you. I don't know about the future any more than any of my clients. Why should I be paid more for that? It's just an illusion that we have to get rid of.
I have a counter question, Pattu. Say you take a mutual fund manager, right? How does one, or a mutual fund distributor is what they're called, how does one take out the conflict of interest from their model? Is there any way? You can't.
I have a dream. It's the idea is just like you have SEBI registered investment advisors. You make SEBI registered mutual fund advisors.
Yeah.
You make all mutual fund distributors, mutual fund advisors registered with SEBI, and you get a fee from the investment, not the investment value. That is, if I invest 1,000 rupees, you get a fee of 1% from that 1,000 rupees, not from the market value. You deduct that 1%.
And not from the profit.
Exactly. You deduct that 1% and invest the remaining in the mutual fund. Remove the distinction between regular plan and direct plan. And remove all ties between the AMCs and the intermediaries.
Absolutely. Wow.
Then the conflict will go away. But nobody will do it.
Yeah.
Because the SEBI has got people who are themselves part of the industry.
It's always been a weird one for me to understand, sorry to interrupt, that SEBI allows you to charge a percentage of AUM, but not of profits for these
financial advisors.
Yes.
The PMS guys can do it. The stock portfolio managers can they have a hurdle rate kind of thing.
Right.
And the biggest problem in India is the structure. See, a regulator regulates financial products. That means, that gives you an impression that they are working for the benefit of the investor, right? Of the participant in those products. Yeah. That is true. But what is also true and not explicitly or discussed is they are also promoters of certain products.
Yes.
SEBI has done a lot to promote mutual funds. They have given incentives to distributors in non-metro cities to sell mutual funds. You can't be a promoter and a regulator. There is a conflict of interest in the regulator to begin with. Look at the NPS. It's called the NPS regulator is Pension Fund Regulator and Promotion Agency. So it's IRDA does that. So all our regulators, they're promoting products which the government thinks is important, and they are also trying to protect the investor. I'm not saying they're not doing a good job, but there's a conflict of interest there, and that has to go. That will never go.
Cool. I hope that answers it for you, Navodit Jain, and a lot of listeners who constantly have questions about this.